Hello everyone, this is Riya Singh, the Senior Currency Research Analyst for Nirmal Bank. Let's look at what has happened into the currency market so far. Now we have seen pound drastically take on with a bullish momentum from the lows. There is a Bank of England policy meet later today, and we are expecting a rate hike of 75 bips on that front, taking the policy rate to 3%. The major highlight into the policy will be the statements and the forecast that Bank of England will provide. They have to provide quite extensive guidelines and forecast in order for the market to analyze and see where they are going or where the policy will be headed in the coming quarters. Of course, if you look at the pound, the major rally was fueled on the back of change into the government and rollback of the ultra loose monetary policies that the trust has had rolled out. So now it looks like that all this news is losing steam, and the focus of the market has shifted towards the gloomy prospect of the UK economy, which is going through the energy crisis as well as the soaring inflation. So overall, I think pound will continue to remain weak against the dollar, and the guidelines by the Bank of England and of course the autumn budget by the new PM Rishi Sunak will play a major role in getting the confidence back into the UK economy, and then we could see some stabilization happening into the pound as well. Until then, you'll see the pound in the bearish run. As expected, Federal Reserve went forward with another 75 bips rate hike, taking the interest rate to 4%. This is the fourth 75 bips rate hike that we have seen by the Fed. Along with the interest rate hike, Fed has said that henceforth the rate hikes will be on a smaller incremental basis. Thus, the quantum could be estimated going towards with the 25 bips rate hike in the coming policy meet. Of course, there is another word that they have added into their vocab is the cumulative tightening. If you look at the statements that is coming from the Fed, it is more towards an hawkish than the dovish, because when asked, Federal Governor Jerome Powell has clearly stated that it is way too early for them to even think about pivoting the interest rates or even starting a discussion on the pause. The numbers that are showing or coming from the economy still indicates that the inflation runs high. The industrial market as well as the job market still remains strong, thus giving more space or power for the Fed to continue with the rate hikes, though not of the same quantum of 75 bips rate hike. But of course, this will definitely lead into the dollar strength and will let the dollar index to remain in the stronger range for a bit longer time than what was expected. Euro will most likely be in the range of 1 to 0.94, because if you look at the economic numbers that have been posted out of the EU, it is strongly indicating the deterioration into the economic health, especially the numbers which are posted by manufacturing and service PMI, which are both running below the 50 mark, thus fueling the recession fears. Now recession fears and stagflation are both of these parameters have fueled into the bearish leg of the euro. Now going forward, of course, the ECB is still quite behind the Fed when it comes to the aggressive rate hikes. They have said that they'll continue with the rate hikes, but as far as QT is concerned, they are still having a discussion onto it. Now, if you look at the inflation numbers, it has remained at 10.7%, which is an all-time high, with the core inflation running at 5%. So a lot needs to be done from the ECB side. Now, right now, I think the small bullish leg that we have seen into the euro has been fueled mostly because of the mild weather condition which has postponed the spike into the demand of the energy. However, the risk to this remains, because if there is a turn of weather towards a harsher side, there will be a demand that will be coming forth. And though right now the reserves of the major economies into the Eurozone are running at 95 to 99% capacity, it will only be sufficient to fulfill the demand for the 90 days before reaching an ultra dangerous levels. Thus, going forward, there won't be any strong bullish or recovery into the Euro USD, and we are seeing it mainly remaining between the ranges as stated before. Thus, to conclude, dollar index will continue to hold the range of 114 to 110 as long as Fed remains towards rate hikes, and this will translate into the USD INR as 83.50 will remain a very strong resistance, and 80 to 60, 80 to 30 will remain as a very strong support for the rupee. Unless there is a breakout to either of these ranges, there won't be any directional momentum going forward. Thus, maintain those ranges as your resistance and support going forward as far as USD INR is concerned. Thank you for listening.